Hey everyone, let's jump right into this explainer. Today, we're putting on our financial economist hats to dissect the global monetary system. We're going to look past those flashy daily headlines to truly understand the underlying structural power and, honestly, the emerging vulnerabilities of the US dollar. If you want to know exactly why the world's economy runs on greenbacks and what it would actually take to upend that, you're in the right place.
Here is our roadmap for today. We are covering the dollar's historical rise, the dominant currency paradigm, capital markets and portfolio theory, weaponizing the financial system, evaluating de-dollarization alternatives, and finally, the costs of moving away. All right, kicking things off with Section 1, the dollar's historical rise.
To understand the dollar's massive inertia today, we really have to look at the decades of deliberate geopolitical engineering that got us here. It definitely didn't happen by accident. The modern system evolved in three key phases. First, 1944, the Bretton Woods Conference. The U.S. comes out of World War II holding over 70% of the world's gold reserves, so it anchors the global system by pegging the dollar to gold. But fast forward to the 1960s, and the overhang of dollars held abroad is completely dwarfing those actual gold stocks. That brings us to 1971, the Nixon shock. The U.S. suspends gold convertibility, and boom, the dollar transitions into a liberated fiat currency. Finally, after the oil crisis, we get the 1974 petrodollar system. This stabilized global demand by ensuring Saudi oil was priced in dollars, which then just got recycled straight back into U.S. treasuries.
Now, what's super fascinating about that early era right before the Nixon shock is something called the Triffin dilemma. It's this wild economic paradox. See, as global trade expanded, the world desperately needed more dollars. But to supply those dollars, the U.S. had to constantly run balance of payments deficits. And here's the catch. Running those exact deficits ultimately undermined the world's confidence that the U.S. could actually back all that paper with physical gold. This inherent contradiction is literally the thing that forced the monumental shift away from a gold-pegged system.
Before we get into the structural math of how things work today, let's lock down a term you're going to hear a lot: liquidity. In plain English, liquidity is the absolute lifeblood of global finance. It's your ability to buy or sell massive quantities of an asset incredibly fast without moving the market price. We're talking about shifting billions of dollars in seconds. This, right here, is the core reason nations and huge corporations flock to the dollar.
And closely tied to that is reserve status. When a currency has reserve status, it is way more than just national pride. It means the currency is held in vast quantities by foreign central banks to stabilize their own exchange rates and grease the wheels of trade. It's essentially the fundamental operating system for global savings.
Okay, moving right along to Section 2, the dominant currency paradigm.
When we look at the hierarchy of currencies, the stark reality of the dollar's dominance just jumps right out at you. Get this. The United States accounts for only about 10% of global trade flows, yet the dollar acts as a vehicle currency on one side of roughly 88% of all foreign exchange transactions, and 50% of global trade is invoiced in US dollars. Think about that. If a Brazilian exporter sells soybeans to a Malaysian importer, that transaction is almost always priced and settled in dollars. That dynamic forces everyone, everywhere, to hold dollars.
That brings us to Section 3, capital markets and portfolio theory.
So we know central banks hold dollars for trade, but why do they stubbornly hold trillions specifically in U.S. debt? Well, it's all in the deep structure of capital markets. Think of the mean variance portfolio theory equation like the actual source code of global finance. Don't worry, you don't need a PhD in math for this. The formula basically proves that an asset becomes dominant when it offers incredibly low variance, which just means low volatility and high stability. Because the U.S. Treasury market is valued at over $26 trillion, its variance is virtually zero. So mathematically, it just naturally dominates optimal portfolios, even if the expected returns are totally modest. To translate that theoretical math into everyday language, global reserve managers prioritize the return of their capital way above the return on their capital. It's all about safety over yield. When you are managing literally trillions of dollars in national savings, your only goal is to sleep well at night. You need to know that if a sudden crisis hits, you can sell a massive chunk of assets without completely cratering the market price.
And when you compare the alternatives, you quickly see why they fall short of that safety standard. Take the euro. It's severely crippled by a fragmented sovereign debt market. A German bond is fundamentally different from an Italian bond. That introduces variance and risk. On the flip side, the Chinese yuan is boxed in by strict capital controls. The impossible trinity of economics dictates you literally cannot have a fixed exchange rate, independent monetary policy, and free capital movement all at the same time. China chooses to prioritize the first two. This means heavy regulatory friction prevents global investors from freely moving massive sums of money in and out. And for a true global reserve asset, that's a total deal breaker.
Next up, Section 4, Weaponizing the Financial System.
Despite all these massive structural advantages the dollar has, recent geopolitical conflicts have thrown a giant new variable into the mix. Analytically speaking, we are in a completely new paradigm. Since most international transactions eventually touch U.S. correspondent banks digitally, they technically fall under U.S. jurisdiction. This gives the U.S. the ability to enforce secondary sanctions, literally cutting entities off from the global financial system. Now, nations all over the world are sitting at the chessboard, weighing a brutal trade-off. Do they stick with the unmatched market liquidity of the U.S. dollar, or try to escape the rising political risk of sudden financial exclusion?
And that political risk premium became absolutely undeniable in February 2022. After the invasion of Ukraine, G7 nations froze roughly $300 billion of Russia's sovereign foreign exchange reserves. This was a massive shock. Historically, sovereign reserves were treated as untouchable, completely safe no matter what political disputes were going on. Freezing those assets fundamentally altered global trust. It proved definitively that dollar and euro reserves are not entirely risk-free. They can actually be revoked during a geopolitical crisis. This leads us right into Section 5, Evaluating De-dollarization Alternatives. So, naturally, that unprecedented freezing of sovereign assets kicked efforts to build alternative financial infrastructures into high gear. But let's look at the data objectively. While headlines constantly scream about de-dollarization, the structural reality is a lot more complicated. Take gold. Yes, central banks bought a record 1,313 tons in Q3 2025 to hedge their bets, but try paying for a massive cargo ship full of semiconductors with literal bricks of physical gold. It just doesn't work for daily global trade. What about China's SIPs and digital ECNY? Really fascinating innovation for sure, but they can't even come close to bypassing the massive entrenched network effects of SWIFT, which connects over 11,000 institutions across 200 countries. And even when BRICS nations start invoicing trade in their local currencies, the actual liquidity sourcing and hedging usually just routes right back through deep, reliable dollar markets anyway.
Finally, wrapping up with Section 6, the costs of moving away.
Breaking away from a dominant vehicle currency isn't just about a country deciding they want to try something new. It requires a painful, incredibly expensive rewiring of global macroeconomics. Moving to a fragmented, multipolar currency system means you completely surrender the efficiency of a single global standard. Suddenly, you're trading across multiple niche currency pairs, like the Brazilian real to the Chinese RMB, which drastically drives up hedging costs. It reduces liquidity, essentially slapping a heavy, invisible tax on all global trade. On top of that, when you start reconfiguring supply chains along geopolitical lines, what they call friendshoring, you create persistent structural inflation. And why should you care? Because structural inflation means higher prices for literally everything you buy. In fact, the IMF estimates this kind of systemic fragmentation could wipe out anywhere from 2% to an astonishing 7% of total global GDP.
So, as we wrap up this explainer, I want to leave you with a final thought to ponder as you watch global finance rapidly evolve. The dollar system might very well be a monopoly with immense geopolitical leverage. But when you consider the massive frictional taxes, the persistent inflation, and the sheer loss of global GDP that comes with fragmentation, you really have to ask yourself, is the cure of de-dollarization actually worse than the disease? Thanks so much for joining me today, and keep questioning the structures around you.